It is Wednesday, February 21st. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through this morning, so therefore we will pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the individual charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month focuses on global risk developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report, the macro, regional, and U.S. economic developments. As I so often do, I'd like to tie them together into a single discussion concerning what I see as concerns with global liquidity, global credit and debt, and global flows. I would therefore like to cover the items outlined here. Let's start by making sure we understand the terminology we'll be using in our discussion today. Too many times I hear people use these terms in the wrong and often confusing context. Liquidity is about availability of money and credit. This is the role of the central bankers, that is, to ensure there is always sufficient but not excessive money supply available. Historically, the problem was normally insufficient liquidity. In the last 2 decades, it has become more a matter of too much liquidity causing the problems. Monetary policy too loose for too long a period of time. The role of the central bank had been to take away the punch bowl just as the party got going, but before it got out of hand. Not the case today. As a matter of fact, it seems quite the opposite, but that is for another discussion. Credit and debt are simply two sides of the same coin. Credit is about lenders having the ability and willingness to lend, and debt is about the need for and having the collateral or credit rating to actually be a borrower or to borrow. Flows, on the other hand, is about where money and credit will go, fully realizing it always goes where it is treated best. We are going to explore all of these in the discussion on a global context. This is another important point because we too often don't properly distinguish whether we're talking domestically or globally, too often assuming in America, at least, they are one and the same. They're not, clearly, and more so today than ever before. Today, the global context is critically important because as far as these terms are concerned, there are no longer any borders and move at light speed around the globe as electronic bits. First, starting with liquidity. We need to fully understand that we are in the process of a global regime change regarding specifically liquidity injections by the central banks into the global economy. Since the 2000 and 2008 great financial crisis, we have experienced unprecedented levels of liquidity injection by the central banks. Prior to the GFC, it was primarily about Japan's massive injections and the Japanese carry trade it fostered. After the GFC, it was initially the Federal Reserve's adoption of various versions of quantitative easing and Operation Twist, followed in 2012 with the European banking crisis and the ECB and the Bank of England joining the Fed and the Bank of Japan. Both the ECB and Japan, however, took it to a completely different level in early 2016 with global liquidity injections of $200 billion per month, with subsequent highs approaching over $250 billion per month in 2017. Today, the Fed has stopped, which it did with the culmination of taper in the fall of 2014, along with the Bank of England, or the BOE. However, the others are still injecting, though more slowly, at a rate that approximates $135 billion per month. This is still a gigantic rate, even compared to the peak of the U.S. quantitative easing programs. It is important to remember, as in this chart and the others we are about to discuss, that China, that is the People's Bank of China, is not included. There are technical reasons for this, and consequentially, we will discuss China separately at the end. The Federal Reserve has not only stopped liquidity injections through its quantitative easing programs, but has now went into reverse. U.S. quantitative tightening, QT, or normalization, is now withdrawing liquidity from the system. Balances of U.S. Treasury bills, notes, and bonds, as well as mortgage-backed securities, are planned to shrink by $420 billion this year, $600 billion in 2019, and $600 billion every year going forward, until the Fed deems the level of its holdings normal, whatever this is. Prior to the GFC, the Fed's balance sheet approximated $1.5 trillion and peaked before normalization at approximately $4.5 trillion. In January, which we just completed, the plan called for a shedding of $20 billion under normalization, $12 billion in U.S. Treasuries, and $8 billion in mortgage-backed securities. My colleague, Richard Duncan, uses what he terms the liquidity gauge to assess U.S. liquidity levels in his macro watch reporting. He is presently highly concerned with the path the Federal Reserve has embarked on, shown here for 2018-2020. He believes it is ill-framed, and if maintained, will plunge the U.S. into a deep and protracted recession. But the problem in the U.S. is worse than this because the Federal Reserve is raising rates at the same time, which additionally reduces liquidity by paying the banks more to keep the reserves on deposit with the Fed versus lending them out, unless, of course, longer rates rise substantially. Both policies of normalization and raising the Fed funds rate can be expected to result in slowing money supply growth. The Fed is currently setting expectations for 3 more rate increases in 2018, as shown here. You will notice the trend line I've drawn in. There is a level at which these rates will stall the economy, a rate that has been consistently falling. This boundary condition, if I can call it, approximates 3 to 3.5% on the U.S. 10-year Treasury. Many well-known experts are on record as saying 2.65 and 2.85 on the 10-year U.S. Treasury will bring about a stock market correction. As we talk, the 10-year U.S. Treasury is at 2.91%. This is not a very pretty picture for the U.S., but the Fed sees it has no choice. Why? 5 reasons, at least. 1, they see we are late in the economic, business, and credit cycle, which has been longer historically than all but one. 2, we have full employment, historically low unemployment rates, and a minimum output gap. 3, the amount of fiscal stimulus now being brought by a new tax bill, Trump's massive unbalanced budget, a $1.5 trillion proposed infrastructure bill, and over $80 billion in hurricane relief can only be seen by the Fed as ensuring inflation, which they must be prepared to contain by getting out in front of it early. 4, the Fed historically requires 3 to 4 percentage points of rate easing to fight a recession, which it currently simply doesn't have to fight with. 5, the level of excess leverage, speculation, overvaluation, and financial fragility must have the FOMC worried and staying up late at night. I suspect the Fed feels it can tolerate a stock market sell-off if it has to achieve the required buffer. However, it cannot withstand the debt market imploding, which many, including myself, are actually more worried about. I also sense the Fed would no doubt prefer to head into the next downturn, not only with the historical rate buffer I referred to, but additionally with equity markets lower and with less elevation to suddenly plummet from, and the Fed expected to restore. The European Central Bank, or the ECB, has also begun reducing its rate of liquidity injections. It reduced its monthly bond purchases from 60 billion euros to 30 billion euros in January. It will continue at this rate until September, at which time liquidity injections go to 0 or are possibly extended a little longer, but at the 30 billion euro per month rate. The ECB has not yet announced a normalization program for its ballooned and now approaching a $4.5 billion balance sheet. In case all of this is beginning to worry you, it gets worse, at least as far as what the stated policy objectives are concerned. The Bank of Japan is also sending signals it may begin reducing its rate of injections, but presently are seen to be simply maintaining their existing rate in 2018, which is still quite substantial, shown here in red. There is a lot of speculation on what BOJ will do, which is not shown in this chart, remembering it is also buying Nikkei stocks and is now reporting to own approximately 5% of the Nikkei stock equities, primarily in the form of ETF ownership. This chart shows forecasted levels for the BOJ for 2019 in red, also potentially quite dramatic. The Bank of England, highlighted in green, as I mentioned earlier, has stopped injections altogether, but has not announced a normalization program yet. Of course, all this can change very quickly if economic projections are not found to be as good as they currently are forecast to be. There's little doubt in my mind that this will be found to be the case. The question is, when will the central banks determine this, and how bad will things get first? Also, whether they can effectively do anything about it when and if something unexpected might occur. So what we do know with relative certainty is that the global liquidity is going to significantly tighten in 2018. We are in the process of a major economic regime change. What about credit and debt? What is going on there, and what might we expect? It likely comes as no surprise to most of our listeners that the rate of savings in the U.S. is steadily falling. However, when we refer to savings, we too often think of it only in the context of household savings. It is broader than that. Savings also includes, economically, profits from business entities, corporate profits which are eligible to be reinvested, theoretically, into productive assets or used for whatever purpose. Today, profits are predominantly earmarked for corporate stock buybacks and dividend payout, not capital investments. This has been a mainstay buyer in the markets now for well over 5 years. As you can see, the total of the two together is still falling. That would be fine if borrowing was the same or less. Here we see this is not the case. U.S. borrowing is increasing at a dramatically larger rate than savings. As a consequence, the U.S. must borrow from foreigners to finance its borrowing. Again, this is likely no surprise. What may be a surprise is that when we subtract the annual government deficit from total U.S. economic GDP, we now get a dramatically negative number. It is much worse if we add the total deficit between savings and borrowings, not just the government deficit shown here. This says the situation is unsustainable in the long term. But what is the long term? Because it has been going on for a while now. The answer lies, as you will see, when global flows no longer head to the U.S. as investment to satisfy ever-growing borrowing needs. That coming shift has a lot to do with the size of the total debt, both public and private, in relationship to the size of the economy or the economy's ability to sustain payments. A big part of the sustainability is the public sector's ability to tax the private sector and the private sector's ability to pay. Well, that number is now over 300% of GDP, with the national public debt at $21 trillion and estimated to be headed towards $30 trillion within a few years. Can it be paid? Very importantly in determining that is at what rate of interest will be required. Remember that $30 trillion deficit number doesn't include unfunded entitlements and contingent liabilities associated with the fiscal gap. Again, it's much worse than it appears on the surface, and that's bad enough in itself. We are now starting to get to the rub of it all. The chart on the right is the U.S. trade-weighted dollar chart, or DXY. You can see at the top a red arrow showing when President Trump was elected. My point here has nothing to do with Trump or political persuasion. This has to do with the realities of economics, and I want to make sure that I make that very, very clear. The DXY has been falling ever since. Why? There are a number of reasons, but one is his reflationary policies are seen to be a problem for lenders' willingness to lend. The risk of lending has increased, and that is now being addressed by reducing the value of what their loans will be paid back in. Last fall, on September 8th, there was a high-level meeting of congressional leadership at the White House. I believe it was a very important, though secretive, meeting. I posted all the details at MATA-SII because congressional leaders were forced to face there the stark realization that there was an urgent and growing need for the U.S. to stimulate in a massive way so a U.S. recession or possible global recession could be averted. Ever since, things have quite significantly changed despite all of the apparent public bickering that goes on between the parties. Since then, we've had close to $80 trillion in hurricane and disaster relief for Texas, Florida, Puerto Rico, and California go through without a wink. 2, we've enacted the biggest tax reduction in American history without any fiscal cuts to pay for it. 3, we've removed the debt ceiling for 2 years through a continuing resolution full of Republican and Democratic spending of at least 60 to 80 billion for each of the parties for their pet programs. 4, we've witnessed Trump announce a $1.5 trillion infrastructure plan with little or no objection so far. And 5, Trump announced a budget that completely removes any semblance of being a balanced budget, which Republican fiscal conservatives campaigned on and was thought to be the cornerstone of Republican policy. A budget that is based on extremely optimistic economic projections and no recession, which still takes the national deficit to $30 trillion approximately. Well, none of this is good news, but so far, we're only talking U.S. borrowing needs. What about the foreign lending to the U.S.? The problem here is that the U.S. is leaning into a storm where its largest creditors, which are Japan and China, have been selling U.S. treasuries, presently, in the case of Japan, in a big way. As a consequence, Moody's is threatening a U.S. debt downgrade despite they and the other credit rating agencies suffering the incredible predatory wrath of the U.S. government the last time they did this. It must be very serious for them to challenge the gods, knowing full well it will mean being impaled in some sort of fashion. Back in 2011, Standard & Poor's shocked the world and the Obama administration when it dared to downgrade the U.S. from its vaunted AAA rating, something that had never happened before, and led to the resignation of S&P's CEO and a dramatic crackdown on the rating agencies overall, led by Tim Geithner. Nearly 7 years later, with the U.S. on the verge of another government shutdown and the debt ceiling breach, with the agreement reached only after the midnight hour, literally, this time it is Warren Buffett's own rating agency, Moody's, which warned Trump that he too should prepare for a downgrade from the #1 rater that was smart enough to keep quiet in 2011. Moody's reasons? Trump and the Republican Democrats' aggressive fiscal policies, which will sink the U.S. even deeper into debt insolvency while widening the budget deficit, resulting in, and I quote, meaningful fiscal deterioration. In short, a U.S. downgrade due to Trumponomics is inevitable. Even without it, global leaders know the reality of the risk of lending to the U.S. with their printing presses and a president who built a career, frankly, on debt and acknowledges proudly that he is the king of debt. It is tough to change a zebra's stripes, and global lenders see that quite clearly. I believe, at least. At MATA SII, we track changes in global credit defaults to give us advance warnings of problems in the credit markets. As you can see from this historical grid we put together, credit default swaps are at extremely low levels, and nothing appears wrong on the surface. Actually, it's quite the opposite. Risk is determined historically based on the risk-free benchmark, which is the U.S. 10-year Treasury note. This has been controlled and managed down by central bank buying since the great financial crisis. That is about to change. Overlaid on that is the VIX, which is a measure of volatility risk measured by option pricing. As the world discovered on February the 5th, this has been manipulated heavily by various ETF and ETN instruments as the VIX settles at likely a higher level, a new normal after the recent shock. Risk will need to be remodeled upward. We are already seeing this in risk parity funds and the high-yield bond arena. There is much more to come here, but suffices to say that these green boxes will soon start to turn all red. You can almost see the cycle in this table. Another instrument we watch is the credit impulse. This is the derivative of changing rates of credit growth. On a global basis, the real creator of credit has been China, which so far we have not mentioned. They are attempting to reduce credit growth in a significant way. If they continue on their current path, we have a massive credit problem. I am skeptical they will, but nevertheless we see growing global credit stress. Let's shift the flows. Money goes, as I said earlier, where it is treated best to supply the credit for desperate borrowers and debt addiction. I think the market turmoil is instructive. I showed earlier that Japan is selling U.S. treasuries. Remember that these treasuries are owned by the Bank of Japan as foreign currency reserves, Japanese banking institutions desperate for yield, and a huge Japanese private investment community. Japan has been in some form of the quantitative easing business for over 2 decades, and out of it has emerged the infamous Japanese carry trade. Borrow at negative interest rate in Japan with a falling Japanese currency, and lend internationally at higher rates in rising or strong currencies like the US dollar. And you pocket the difference, which is substantial. However, when things get chaotic in foreign markets and investment risk rises, the Japanese private investment community famously retreats home quickly. The carry is quickly taken off. When this happens, normally the dollar falls as foreign US dollar denominated assets are sold, with the yen rising with repatriation. This is exactly what has been occurring for a while now regarding US treasuries, which is helping push yields higher, and there seems to be few that are really focusing on this. However, there is more going on than just that. Secondly, since Trump, there has been a steady capital loss on the 10-year U.S. treasuries as yields have climbed. And as you know, yields move in reverse to price, and the U.S. dollar falling, which we showed earlier since Trump assumed office. This is not good when you're in the carry trade and you try and get out of a situation like this. Thirdly, the carry is now costly as a result of suddenly imploding U.S. JPY cross. There has never been a worse time to buy U.S. treasuries for Japanese investors, traditionally some of the most ravenous purchasers of U.S. paper. U.S. funding costs for Japanese insurers and banks to invest in U.S. treasuries has surged, reaching a post-financial crisis high of 2.35 on December 15th, and that is determined by 3 things. 1, the difference in U.S. and Japanese risk rates, or the OIS. 2, the difference in U.S. and Japanese interbank risk premiums, that is, LIBOR minus the OIS. And 3, base swaps, which illustrate the imbalances in currency-hedged U.S. and Japanese investments. In this particular case, widening of 1 as a result of the Fed rate hikes and tightening of dollar funding conditions inside the U.S. number 2 and outside the U.S. number 3 have occurred simultaneously. This is illustrated in this chart taken from Zero Hedge, which they published in an article when Trump signed the tax bill in December entitled, "In an Unexpected Outcome, Trump Tax Reforms Blew Up the Treasury Market." Whatever the cause behind these sharp funding shortages, one thing was clear. Dollar funding costs, that is, foreign exchange hedging costs for both Japanese insurers, banks, and other investors to buy U.S. treasuries, were surging with Japanese buyers and reached a post-financial crisis high, as I said, of 2.35 on the 15th of December. And in terms of practical implications for the Treasury market, this means that all else equal, marginal demand for U.S. paper is about to plunge for one simple reason. Foreign currency hedged yields on U.S. Treasuries have plunged to negative levels never seen before, unless, of course, foreign investors buy U.S. Treasuries unhedged. To demonstrate this point, the chart below from Deutsche Bank shows the yield on currency-hedged U.S. Treasuries from the perspective of Japanese investors. Annualized hedge costs had risen to 2.33 at the end of December, which means that investments in 10-year U.S. Treasuries would result in virtually no yield. Furthermore, yield from investment in shorter than 10-year yields would be less than the Japanese government bonds and result in negative spreads. Fourth reason here is there is a need for money to continue to maintain 0% on the 10-year Japanese bond in Japan as pressures mount for the natural rate to increase. They need the capital. They need the money. Now, this is not the private investors. I'm talking about the Bank of Japan here. But to be sure, it isn't just the Japanese carry trade. Central banks overall have been steadily losing interest in holding U.S. Treasuries. That could be for a number of reasons, including pressures on their own foreign exchange reserve levels. Saudi Arabia is a good example that jumps right off the paper of that, with the pressures on them to maintain a dollar peg, and that runs right around the world right now. Global flows are only beginning to change. Charts like this will soon see a change in direction. I've intentionally stayed away from China, who are the world's largest creator of credit, because what they will do going forward is almost impossible to quantify. There are a number of reasons for this, ranging from government control of banking, exchanges, and state-owned enterprises to questionable statistical reporting to the sheer complexity of their shadow banking system, which is attempted to be shown here from the Bank of International Settlements. It is anyone's guess on what they will do. The IMF expects China's total debt to double from 27 trillion in 2016 to 54 trillion in 2022, 3 years from now, or 4 years, full years, just around the corner. That is more than a 5-fold increase from 2009. How will this debt be financed, with pressures already on their foreign exchange reserves, with them, as we've seen, selling U.S. treasuries? Richard Duncan is as close to China as anyone, though he lives in Thailand and works in Singapore. He thinks they will just issue credit by literally printing their currency, not backing it by anything. China, no doubt, has learned from the United States. A cheaper yuan, which will result from this, is something they actually want and need anyway. As Richard warns, the world is not prepared for the wall of money that could come flooding out of China during the next few years. With the world increasingly desperate for credit, China may be the savior. Could they be the source of the next reflationary central bank push? But at what price? Beware the lender. There's always a strategy. So in closing, as I always do, a reminder. Remember, the answer will be to print more money. It is the only answer politicians will ever agree on, until no one wants it or trusts it, that is. Invest accordingly. I'd like to take a moment as a reminder as we close. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2018 turn out to be an outstanding investment year for you and your family. And I thank you very much for listening.